So, a balance sheet is a financial statement that reports a company's asset, liabilities, and shareholders' equity. The balance sheet is one of the three core financial statements used to evaluate a business. And the accounting equation of it is asset equals liability plus owner's equity. Next, please. So this is the example of asset in a balance sheet. Under the current asset is a cash, account receivable, inventory, prepaid cash, and you need to total the current asset rather. And in the fixed asset, we have machinery and equipment, furniture and fixture. And of course, you need to total it and less the depreciation to have a net value to have your net book value. And the other asset, for example, the example of it is patent, then the total asset. Next, please. Liabilities and owner's equity. In the current liabilities, under of it is account payable, accrued liabilities, and the total current liabilities, and the long term liabilities is a DP loan. And you need to total the liabilities again. And the owner's equity is, for example, is shirt tails, capital, or accumulated profits, and the total owner's equity, then the total liabilities and owner's equity. Next. So there are three balance sheet classification: asset, liabilities, and owner's equity. Asset, and next please. Asset property owned by a person or a company, regarded as having a value and available to meet debts, commit, commitments, and legacies. Example of it is cash, marketable securities, accounts receivable, stock or inventories of raw materials, supplies and finished goods, and prepared expenses. Fixed asset are the non-current asset, meaning that assets have a useful life of more than 1 year. Fixed asset include property, plant, and equipment, or we for short is PPE, and are recorded on the balance sheet. Under of fixed asset is land, building, machinery, equipment, furniture, and fixture. Other assets are the miscellaneous assets that are cannot be classified as current asset or fixed asset or even intangible asset. Next, please. Liabilities. Liability is a something a person or a company owes, usually a sum of money. Under of liabilities is current liabilities and long-term liabilities. Current liabilities are often understood as liabilities of the business that are be settled in cash within the fiscal year or operating cycle of given firm, whichever period is longer. And the long-term liabilities is these are the normally borrowings from banks and or other financial institution. They are be paid for a long period of time that the normal operating cycle usually 3 years or more. Next, please. Owner's equity. Owner's equity is the equity of ownership of the asset that may have debts or other liability attached to them. Equity is measured of for accounting purposes by subtracting liabilities from the value of an asset. Next, please. Valuing asset. All assets have be valued. Hence, the problem lies is deciding on that value. Here are the three guiding principles. First is the firm is going concern. Second is the way you value has to be consistent year after year. And lastly, you value prudently. Next, please. Current asset, they are usually valued at cost. In other words, at price at which was paid for them or reflecting the costs that have been spent on them like prepaid assets and inventory. Next, please. Fixed assets are this loss of value is called depreciation and it cost of the company and comes of its profits. And there are three basic causes of depreciation. First is wear and tear. It means things get worn out with use. Obsolescence is things become out of date or old fashioned. And age is the second hand asset are not as valuable as brand new ones. Next, please. Accounting treatment of depreciation. The most common method of depreciating asset is known as straight line depreciation, computed as follows, where it is assumed that the loss of value is a permanent loss. The formula of depreciation is depreciation equals to purchase price minus residual value over estimated useful life. Residual value or scrap value is the amount which the asset can be sold at the end of its estimated useful life. Next. Asset life or estimated useful life. The number of years an asset is expected to be useful varies from asset and from firm to firm. There are some general convention. However, building is only 40 to 100 years, and ships is only to 20 to 40 years, and machinery is 3 to 15 years, and a vehicle is 3 to 7 years. Next. Land valuation. Land is forever and therefore no depreciation is chargeable. Instead, land tends to appreciate in a value in the long run because of inflation and shortage. So these days, companies tend to revalue land and often buildings from time to time. Next. Accounting for appreciation of asset. There are several reasons for keeping the value of your asset at up to date values. Having higher values give greater borrowing powers. The accounts are supposed to reflect true values. Undervalue asset make the firm cheaper and thus as easier takeover target. Asset both in 1960 to 10,000, profit therefore in 1993 1,000, return on the asset in the 1993 is 10%, and asset revenue asset revalued is 1993 is 20,000, and revised return on the asset is 5%. Next, please. Cash flow statement is a supporting document that shows the sources and purposes of cash payments during an accounting period. And that is the example of cash inflows. Next, please. Income statement shows that the revenue realized by the business as well as the costs and expenses incurred in the realization of said revenues. Revenues Revenues of the business consist of the sale of goods or services during the period for which the statement was prepared. Expedi- Expenditures consist of production, selling, and other expenses incurred in generating the revenues. These expenditures are the following: cost of sales. Cost of sales are the merchandise and cost of transporting or bringing the product to the firm. Second is the selling expense. These are the expense incurred in making sales. And lastly is the general administrative expenses, which this includes salaries of office personnel, rental, taxes, professional fees, and other payables necessary in the overall administration of the business. Next. Some special costs. Most companies have their accounts checked by the independent accountants. This is an audit and audition. Auditors are legally responsible to the owners. The audit fee is cost all firms bear. If a company owns an asset that lasts over a year, say a building or a machine, then any reduction in its value is considered to be a cost. This cost is a depreciation. In addition to bank charges, many firms borrow money and the interest they pay is cost that they need to be highlighted. So a financial ratio or accounting ratio is relative magnitude of two selected numerical values taken from an enterprise's financial statements, often used in the accounting. There are many standard ratios used to try to evaluate the overall financial condition of the corporation or the organization or the other organization. There, the analysis of ratio involves the two types of comparison. It is the internal comparison and the external comparison. Internal comparison is the ratio can be analyzed from a historical perspective, determining the trend of the ratio and comparing it to the expected future ratio for the company can assess management in the decision making. While the external comparison is the second method involves comparing the ratio of the firm which the ratio of various firms or with the industry averages during a period. Such as comparison gives insight into relative financial condition and performing and performance of the firm. Next, please. So profitability ratio are the metrics that assess a company's ability to generate income relative to its revenue, operating cost, balance sheet, assets, or shareholders' equity. Profitability ratios show how efficiency a company generates profit and value for a shareholders. So for gross margin, it is measured the total margin to cover operating expenses and yield a profit. And the formula of gross profit margin is gross divide sales. For example, the gross profit margin is equal to 18,000. You divide to 30,000, the answer is 60%. Net profit margin indicate net income percentage on products sold, a measure of the firm overall the profitability. The formula of net profit margin is net income after tax divide into sales. So example of the net profit margin is 6,000 divided to 30,000 is 20%. Next, return on asset reflects how the firm has earned from investment of all its financial resources. A key measure of management performance in using asset to generate profits. The formula of it is return in the return on asset is net income over total asset. Return on investment. Measure how the firm has earned on the funds provided by the owners and the long-term creditors. The formula of return on asset is return on asset equals net income after tax over long-term liabilities plus capital. Return on equity shows the return you as the owner will you receive an investment in the business measured firm overall performances. The formula of return on equity is return on equity equals net profit over the total capital. Next. Amping Jen.
So, liquidity ratio. Liquidity ratio gives an idea about company's ability to convert its assets into cash and pay its current liabilities with that cash whenever required. So, current ratio shows whether current assets are enough to cover the current liabilities. The formula for this is current ratio is equal to current assets divided by current liabilities. For example, if a company's current assets are 5,000 and its current liabilities are 2,000, then its current ratio is 2.5, which means that there is 2 pesos and 50 centavos available current assets for every 1 peso current liabilities. Next. Asset test ratio or the quick ratio is similar to the current ratio. Just illiquid assets like inventory are not considered. The formula to get this is asset test ratio is equal to current assets less inventory less prepayments over current liabilities. Or asset test ratio is equal to cash and accounts receivables divided by current liabilities. For example, if a company's current assets are 5,000 and its inventory and prepayments are equal to 2,000 and the current liabilities are 2,000. So 5,000 less 2,000 pesos divided by 2,000. Therefore, its asset test ratio is 1.5, which means that there is 1 peso and 50 centavo cash and cash equivalents available for every 1 peso current liabilities. Next. Solvency ratios are useful in measuring a company's solvency, thereby judging financial health. A company's solvency is defined by how much debt it has and its ability to repay this debt apart from its regular obligations. So debt to equity ratio is a capital structure ratio which evaluates the long-term financial stability of business using balance sheet data. The formula for this is debt to equity ratio is equal to total liabilities over total capital. For example, a company has a total liabilities of 100,000 and a total equity of 250,000, then its debt to equity ratio is 0.4:1, which means that the total capital of the firm is composed of 40 centavos, 40 centavos debt and 1 peso investment of the owner. Next, activity ratio. It measures how effectively a firm is using its resources or how efficient a company is in its operations and use of assets. In general, the higher the ratio, the better. Fixed asset turnover ratio indicates how efficiently a business is using its fixed assets. The formula to get fixed assets asset turnover ratio is equal to net sales over average net fixed assets. For example, if the company has a net sales of 30,000 and an average net fixed asset of 45,000, then its ratio is 67 times. To go deeper, net sales is equal to gross sales less sales, returns, and allowances, and beginning balance plus ending balance, then divide it by 2 to get the average fixed asset. To interpret this ratio, the high ratio means higher efficiency in utilizing the assets, while the low ratio indicates inability of a firm to utilize the fixed assets efficiently. Next. Total asset turnover determines the ability of a company to generate revenue from its assets by comparing the net sales of the company with the total assets. Its formula is total asset turnover is equal to sales over total assets. Higher ratio is preferred as it reflects more efficient asset utilization. However, a low asset turnover ratio reflects the bad management of assets by the company. For example, the company has a total assets of 45,000 and a sales of 100,000. Therefore, its total asset turnover is 222 times. Next. Common size income statement analysis. It is an income statement in which each line item is expressed as a percentage of the value of revenue or sales. Moreover, it is used for vertical analysis in which each line item is in a financial statement is represented as a percentage of a base figure within the statement. It is important to note that the common size calculation is the same as calculating a company's margins. The net profit margin is simply net income divided by sales revenue, which happens to be a common size analysis. The calculation for common size percentages is amount over base amount and multiply by 100 to get a percentage. Remember, on the balance sheet, the base is total assets, and on the income statement, the base is net sales. Next. Given the example in the book, the changes from year 1995 to 1996, it can be noted that there is an overall increase in profit amounting to 4.64% due to increase in cost of sales by 2% and in operating expense by 2.64%. Next. Next pa books. The break-even point in economics is the point at which total cost and total revenue are equal, or in other words, even. There is no net loss or gain and one has broken even. The opportunity costs have been paid and capital has received the risk-adjusted expected return. Next po ko. Classification. Wait. Management can utilize this tool to determine the effect of certain decisions or situations on their operations, such as a lower sales performance compared to the expected volume of sales, an increase or decrease in the selling prices, the hiring of additional salespeople, an increase in the wages of direct labor, the rise in the cost of raw materials and other factors affecting costs, volume of sales and production, and selling prices. In using break-even analysis, it is important to determine your cost, either fixed cost or variable cost. Fixed cost is also known as indirect costs or overhead costs. These are business expenses that are not dependent on the level of goods or services produced by the business. These are rental, salaries of executives, depreciation, wages of indirect labor, and other costs paid based on time. Variable costs are costs that change as the quantity of the good or service that a business produces changes. These are their direct materials, direct labor, and commissions. These costs go up when the production increases and down when production decreases. Next. For example, shirt tails are selling a price for 50 pesos. They have a fixed cost of 8,000. The compute for break-even sales, the formula is break-even equals fixed cost plus variable cost. The variable cost in this case is equivalent to 45% of sales. That is, variable cost over sales is equal to 13,500 over 30,000 equals 45,000. Next. For example, shirt tails are selling a price for 50 pesos and they have a fixed cost of 8,000. To compute for break-even sales, BES equals 8,000 plus VC, which can also be expressed as 0.45 BES. BES equals 8,000 plus 0.45 BES transposed to the other side, which we can get 0.55 BES equals 8,000 and divide both sides by 0.55 to get 14,545 pesos and 45 pesos for break-even sales in pesos. In terms of units, break-even is computed as BS units equals BS in pesos over selling price. 14,545 pesos and 45 cents over 50 is equal to 291 units. Next. The income statement would show the following: sales less cost, that we can get profit or loss. This means that for short tails to break even or to incur no profit or loss, they should be able to sell 291 units or have 14,545 pesos and 45 centavos sales. Next. Budgeting. A budget can help determine the long-term goals and put on the path of working towards them. Planning is one of the more important roles as an entrepreneur does. When an entrepreneur plans, he works out the objective of the business as well as the ways to achieve them. You should always plan for the different phases of your business operations. Financial managers use a tool for this purpose, the budget. A budget is a business plan expressed in terms of money and used for a definite period of time in the future. Next. How is a budget prepared? The preparation of a budget follows the sequence shown below. So first, set the objectives of the business. A business objective may take any of the following forms: a target profit as a reward for the owner's investment, a target sale of a number of units or a share of the market. Second, forecast the volume of sales that a business will achieve for a given period. Third, assess the cost that will be incurred or in producing and selling the planned volume of sales, including the cost of providing the administrative support. Fourth, determine the budget period and compare cost and sales income. Next. Cash management. To keep the business going, it must have sufficient cash readily available for its immediate needs. Therefore, you need to keep a close watch over your cash. This practice is called cash management. There are two primary objectives in cash management, namely, provide adequate cash to meet the needs of the business and safeguard cash from loss due to thief, fraud, other criminal manipulations, and carelessness. Next, provision of adequate cash to meet the needs of the business. In order to meet the cash requirements of the business, you have to determine the expected cash to be received and the expected cash to be paid out for a particular period. In doing so, you can anticipate shortages or excesses. This process of planning cash receipts and cash disbursements to determine cash requirements and cash surpluses is termed as cash budgeting. The use of this tool enables one to be in a better position to provide funds for seasonal needs, provide funds for expansion, develop a sound borrowing program, take advantage of money saving opportunities such as discounts, economic order quantities, and plan for investing excess cash. Next. So the second one is the planning cash requirements. So first makes a sales forecast or estimate of your future sales. For example, you have decided to go into the business of selling cold fruit juice in the town plaza. Let's say that you feel you can dispose of one big plastic container of juice daily, which will fill 50 glasses at 5 pesos a glass. Next box. So this is your weekly sales forecast in the first week. You'll have 350 glasses sold, and for 5 pesos each you can have 1750 pesos each week, which we can total to 7,000 pesos a month sales. Next. So this is your arithmetic straight line method. For example, if sales on the year 1996 is 120 units and sale in the year 1993 is 90 units, so 120 less 90 units, which we can get 30 units for the 3 years. So average increase per year is 30 units divided by 3 years, which we can get 10 units per year. So for the next year, we can get 10 units per year increase. That would be all.
So next is cash budget. So there are steps in preparing the cash budget. First is estimate cash inflows. Estimate the sources of cash inflows like sales of products and services, additional investments, proceeds from loans, collection of receivable, and estimate amount of receipts. In estimating the expected receipts for the future period, the policy of the business or company regarding terms of sales should be considered. Second is estimate cash outflows. There are anticipated disbursements to be considered in estimating cash outflows. The following are cash purchase, payment of credit purchase, salaries and wages, administrative selling and overhead expenses, prepayments like rentals, insurance and the like, loans and interest, taxes, dividends or personal drawings of the owner. Third is compare the cash inflows versus outflows. A detailed month by month comparison would determine surpluses and shortages of cash. This will provide information as to when to put in additional cash and when to use the excess cash for other profitable uses. Next is preparing the daily cash report. It is another tool to provide information and current cash positions. So here is an example of a daily cash report. This is a summary of the cash balance at the beginning of the day and receipt disbursements and cash balance at the end of the day. Dealing with cash shortages. If cash budget shows certain shortages, it is time to look for additional cash. First, from internal resources, and if it is not sufficient, from outside sources like banks and financial institutions. Cash may be obtained internally by restricting credit and speeding up collection, reducing inventories to minimum, including finished goods, work in progress, and raw materials, tightening up on trade relationships and selling what you can do without, like equipment, building, and real estate securities. Next is dealing with excess cash. So if cash budget shows a heavy surplus at a certain period, this surplus must be invested in money or stock market. In this way, the money is not kept but is used to earn additional returns. Next is monitoring and controlling the cash budget. It is important to monitor the activities that ultimately result in cash transactions. Unless you overwatch your credit sales, purchasing goods for stock and pricing, you may run short of cash even if you have an excellent internal control over your cash. Next is safeguarding cash from loss. To safeguard the company's assets, an internal control system employs an automatic check and balance by requiring that the work of one person is reviewed and examined by another. So here are some of the following: separating business funds from the owner's personal funds, and immediate recording of all cash receipts, using a petty cash fund entrusted to a petty cashier for all payment other than check, monthly reconciliation of bank account, approval of disbursements, signing of check and bad debts write-offs by authorized persons, conducting an announced cash count, and careful selection of employees. So why do companies go broke? A company either ceases to trade because of the bank or other creditors stop it, or voluntarily ceases to trade and calls in the receiver of the administration. In either case, the action is taken because the firm is unable to pay its debts or likely to be unable to pay in the near future. Why do firms get into this situation? The accounting information reveals what has gone wrong, and there are two levels of cause. First is the accounting manifestation and the root problem. Accounting manifestation of failure are the following: too much debt, over high dividends, no cash, making a trade loss, no growth, selling parts of the firm at a loss, very poor profit margins, and marginal profitability. None of this on its own is a cause of collapse, but when several appear together, the danger signs are there. Even so, they are all have root causes, and these can be summarized as not selling enough, not modernizing, buying useless assets, failure to control working capital, having cavalier or arrogant dividend policy, not selling at the right prices, no product development or research, failure to control loss, and reckless borrowing. These things do not happen all at the same time, but if the trends are observed over 2 to 3 years, then it is often easy to identify trouble brewing unless management does something drastic and takes corrective action. Next is what makes a successful firm. In contrast to failure, successful firms do all the opposite things to the nine deadly business sins just described. Good firms sell enough of the right things at sensible prices and at the right margin to be able to utilize their assets effectively. They control cost and working capital. They plow lots of profit back. Their borrowing is appropriate to the risk exposure. We can see these virtuous features by looking at their key ratios over time. That's all.